Hi, my name is Jack Murray from MediaHQ, and today I'm talking to Jean-Laurent Pelissier from HSBC about SaaS funding. Welcome, Jean-Laurent, how are you?
Very good, how are you?
Can we start today by talking about your role at HSBC, what it entails about funding and your daily work?
Sure, so I lead our enterprise software team within the venture and growth banking segment. So at Innovation Banking, HSBC Innovation Banking, ultimately we look at supporting companies, startups from pre-seed all the way through to post-IPO. And my team looks after all the companies that are post-Series A through to IPO, and it's about really how do we take those companies through those live journeys all the way through. So my team works with relationship management for enterprise software companies, so it's all B2B software companies with obviously a very wide spectrum of profiles given the stages that we operate in, and our idea is to really kind of support them at every stage with both meaningful introductions to players in the ecosystem, given our reach in the ecosystem, as well as leveraging our HSBC platform to support those companies all the way through.
It's been a very unusual year globally. It's been a year of elections, it's been a year of political turmoil. Does that affect the economic sentiment in the work that you would do? Would you see that in different markets, or does it even out as the year goes on?
Yeah, but I think we can see it through the VC funding in general, right? I think the macroeconomics and the political system does impact funding. The good thing is that if we actually look at the numbers, there's been stability and the rising of interest rates. Things are actually trending down a little bit on the interest rate front, which has brought a little bit more optimism, I think, to the VC ecosystem, which we can see in the data that's in this report.
And global inflation would have normalized in the last 6 months as well.
Of course, yeah.
So the SaaS Snapshot report that you would have done in preparation for this event, give us a little bit of an oversight as to what the highlights for you were in this year's report.
Yeah, I mean, I think the key thing in this report is that we can see through the data that ultimately there's a flight to quality, right? We can see that VC investment is up. The number of VC rounds are down, and what that means is there's actually been more Series C plus investments being done over the last 6 months compared to the same 6-month period in 2023. So investors are looking for companies that are established with sound fundamentals and really kind of a safe haven essentially of companies that have actually proven a product market fit and are really accelerating their growth globally, but in a much more stable and structured way. And
the shift to Series C, if you were to dig into that, what do you think is behind that shift to Series C?
Well, I think investors still need to deploy capital. I think that's key. I think a lot of the later stage companies were also extremely well funded from back in 2021 and 2022 when equity capital was a lot cheaper and much more abundant. But now they're at a point where if they want to keep growing, and keep executing on their plans to become dominant players in the space that they operate in, that they needed to raise further capital. And so I think these companies are back in market. I think a lot of them have also looked at right sizing their approach to ensure that they have sound fundamentals, that they're very efficient companies. Which I think is very attractive to investors, and so that has brought capital back into the Series C plus ecosystem.
We'll get to AI in a second, but fintech showed up well in this survey as well.
Yeah, no, I think fintech is a great spot, especially when you look at kind of B2B software for financial institutions. These are client base that tends to be very resilient, right? Tend to be very sticky client base, and so I can see the value for investors in investing in companies that are B2B software within the fintech vertical, just because of the resilience of the space in general.
So look, AI dominates. They say if you put AI in your name or you put it high up, you're much more likely to get funding. Talk to us a little bit about that and what's behind it, like AI washing, genuine AI, the type of technologies that funds want to invest in.
Yeah, well, look, I think there's a lot of excitement around AI for good reason, and the key reason is that it could have a very disruptive effect in terms of how companies operate, how the economy in general operates, and it really can impact each of our day-to-day lives. And so that kind of technology that can be that transformative on such a large scale will naturally interest investors to come in and support that. We'll have to see how it plays out because it's still quite early in the AI journey. I think we're really at kind of the infancy right now in terms of being able to see how that kind of technology can be applied to solving kind of key business issues. But I think that's one of the key reasons why we're seeing such a huge amount of investment coming through. I think there's going to be a lot of iterations on the technology that's currently available and the types of companies that are out there. But yeah, it's an exciting time.
It's kind of, the Klondike or the gold rush. The normal equations that go on the number of bets a VC will take, whether they fail or succeed. Does AI alter that? Like the fact that it's so hot and so, it's so desired by so many people, are they likely to take more bets? Is there likely to be more money for AI?
Well, I think investors will typically look for a company where they can have an outsized return. And I think AI in general, that's where you can really get the outsized return, and that's why investors are putting money in there at the moment. It's because of how transformative it can be in general across everybody's lives, and so that will attract the capital. Ultimately, I think it's similar to the typical VC underwriting approach in the sense that not all of them are going to succeed. I think also we're probably going to see some of these companies evolving quite quickly based on the technology that's coming out on the AI side, right? I think some of the companies that are available today that are kind of software AI applications are going to be potentially disrupted themselves by new entrants coming in. So I think we're going to see a lot of iteration over the next few years as the AI kind of picks up.
And it's so fast moving that if you take this point on the map and go back 12 months, the speed of the innovation has been phenomenal.
It has been. It has been incredible, and I think it's because of the number of people that are just focused on this and looking at concrete applications of this technology. And I think that's the key. That's the key thing that we need to see how it plays out is how companies and founders are able to take this kind of Gen AI type of development and really apply it to key use cases to solve real business issues.
We know where the hotspots of global finance are, but one of the things the survey pointed out was regional growth, particularly in places like France and Spain. Yeah. Are we seeing kind of an emergence of clusters of innovation that VC are willing to back in those areas?
Yeah, well, I think I think we've seen growth across Europe, but I think some key geographies like France, for example, I think they've gone a long way over the last kind of decade in terms of fostering innovation. So I think naturally we're going to see a bit of a pickup there. Germany also is as a hotbed for innovation. We see a lot of activity there. And so I think that'll continue. I think innovation in general is critical for economies because that is kind of the future and kind of the bedrock for long-term growth. And I think everybody realizes that, and so I think each of these countries are very focused on ensuring that they've got a strong ecosystem and they're fostering that growth. So
we're here in Dublin today at SaaStock. The room is abuzz with lots of early start companies who want funding. Money doesn't discriminate. So if you were to advise somebody who's here today, looking for seed funding, looking for a series round, what advice would you give them about getting to the next level from your experience?
Yeah, well, look, I think, again, I think it goes back to what we discussed at the beginning where, I think investors are looking for companies with sound fundamentals. I think that's, they want efficiency, good metrics, and they want to be able to see that a company, if you invest in, the sales team, the go-to-market strategy, that ultimately they're going to see efficient growth. And so, I would advise that companies focus on their core metrics, that they focus on ensuring that they've got sound fundamentals, sound, product market fit, and then to start fundraising as early as possible, because I think it does take a long time, especially in this environment where there's less money available than there was 2 years ago. I think it's important that companies start that journey early on so that they're not facing more stressful situations further down the line.
If you were to pick a couple of items from the survey that you're really going to focus on, kind of watch items for the 12 months ahead, what would they be for you?
So I think two things. I think it's very interesting the fact that we're seeing an uptick in the amount invested, but obviously for slightly later stage companies. I think what's going to be important now is seeing how do investors create liquidity, all right? And so ultimately we're going to need to see some exits. We need to see some large exits to bring back liquidity into the VC ecosystem, because that's what limited partnerships want.
And they're good for business for you guys as well.
They're great for business, and that will attract further investment in the space. So I think that's key. I think we're going to have to see some of those exits at the later stages. The other thing that's actually quite interesting is just the use for debt over the last kind of 6 months compared to 6 months of the year prior has skyrocketed, which I thought was fascinating. So I think if you look at all the
Why do you think that happened?
Well, I think because if you go back a couple years ago, the availability of equity was abundance, right? There's quite a lot of equity, and it was quite cheap compared to today. And so I think companies didn't have to think so hard about balanced capital structures and ensuring that they're using the right asset class to finance the right kind of growth initiative. I think today, where equity is quite expensive, companies and founders need to think a little bit more about, okay, well, what are some of the different types of capitals available around them? And there's a lot of private credit that's available in the market, and that's a great use case in order to try to accelerate that growth, grow that enterprise value without necessarily diluting yourself along the way.
Thank you, Jean-Laurent. Thank you for joining us today, and thank you for your insights.
Yeah, thank you very much.